Welcome to this explainer. Okay, let's jump straight in and ask a pretty brutal question about retail trading. If you spent any time at all staring at charts, you already know the financial markets can be an incredible way to build wealth. But let's be honest with ourselves here, it can also be an absolute wood chipper for your capital.
So why do most beginner traders actually fail? We all know the allure of easy money, right? You see those massive percentage gains floating around on social media, the perfect entries, the flawless exits. It looks so easy. But the harsh reality is that the market is a highly efficient machine, and honestly, it's practically designed to expose our deepest psychological flaws. Our brains are hardwired for certainty, but the markets, they operate entirely on probabilities. And because of that mismatch, beginners are just constantly battling their own emotions, mainly fear and greed, often without even realizing it's happening. And listen, this isn't just an anecdotal guess or some rumor. A comprehensive 2020 study looking at equity futures traders revealed a truly staggering reality. 97% of all traders who traded for more than 300 days lost money. Literally 97%. It's a painful statistic, but it brilliantly illustrates a harsh truth. If you don't manage your risk, you are absolutely going to become part of that statistic. The market will just absorb your capital.
But we want to keep you out of that 97%, so we're going to explicitly name and unpack the 3 deadly account-killing mistakes every beginner struggles with. Number 1, trading without a hard stop loss. Number 2, oversizing your position. And number 3, overtrading and chasing the market. Let's move right into mistake number 1, trading without a hard stop loss and the dreaded averaging down trap. Entering a trade without a predetermined point where you just admit, hey, I'm wrong, is absolutely the most expensive mistake a beginner can make. The trap usually starts when you enter a position, the price moves against you, and instead of just cutting the loss, you hold on, practically praying for a bounce. And then you do something even worse. You average down. You buy more of the losing position to lower your cost basis, hoping just a tiny recovery will get you back to break even. But the reality? The market can stay irrational far, far longer than you can stay solvent. This completely turns a disciplined, quick trade into a forced, long-term hope investment.
Now, what's really interesting here is seeing exactly where an entry falls apart. Once the price breaks through your logical stop level and you freeze instead of exiting, you are suddenly trapped. You're no longer trading the technicals on the chart, you're literally just trading your hope. And hoping for a bounce instead of taking a tiny, manageable paper cut, that's what wipes out weeks of successful gains in a single afternoon.
So the crucial point is the fix. Before you ever click buy, establish a hard stop in your broker platform. Don't just keep a mental stop in your head. We all know how that ends. Put the actual order in the system. Define exactly where your setup is invalidated, set the hard stop, and, this is absolutely crucial, never ever move it to give a losing trade breathing room. Just accept the small loss and move on to the next setup.
Which brings us to mistake number 2, oversizing an excessive position size. Driven by greed, or sometimes just that burning desire to grow a small account way too quickly, beginners focus entirely on the potential profits. They completely ignore what happens if the trade goes sideways. You might trap yourself by risking 10%, 20%, or even more of your total account on a single setup, maybe even using crazy leverage. And the reality? When your position size is that big, your emotions start swinging just as wildly as the P&L numbers on your screen. You stop watching the chart altogether and just stare, panicked at the fluctuating dollar amount. To put that into perspective with some actual math, let's say you have a $10,000 account. If you risk 20%, so $2,000 on one trade, the slightest dip is going to throw you into absolute panic. You're going to cut your winners way too early out of fear, or you'll just freeze in total indecision when you're deep in the red. But look at the professional risk profile. Risking just 1%, which is $100. At that size, you're calm, you're objective, and your heartbeat isn't pounding in your ears. And that brilliantly illustrates the fix here. Adhere to a strict 1 to 2% risk rule. Even if the trade totally fails, 98% of your capital is perfectly preserved. It's safe. You want to keep your position sizes so small that an individual loss feels like a completely minor, boring cost of doing business. It shouldn't be a catastrophic financial disaster, right? Finally, let's explore mistake number 3, overtrading and chasing the market. So even if your stops are tight and your sizing is perfect, this urge to constantly do something or just click buttons can still bleed your account dry. The trap manifests in 2 ways. First, taking subpar setups out of sheer boredom because the market is chopping sideways. And second, FOMO, the fear of missing out.
This is when you see an asset making a massive vertical move, you panic that you're missing the easy money, and you chase it. You end up buying at the absolute top, literally seconds before it reverses. We've all been there, right?
Okay, let's dive into the reality of this. The more you try to force trades, the more you expose your hard-earned capital to random market noise. You're racking up transaction costs, commissions, slippage. It's death by 1,000 cuts. Furthermore, this almost always leads to revenge trading. You take a loss, get mad, and immediately jump back in on a terrible setup to try and win it back. Spoiler alert, you just dig a much deeper hole. You have to treat your capital like ammunition. You wouldn't just fire randomly into the woods, would you? Of course not. True consistency actually comes from waiting incredibly patiently for your specific, high-probability setups to print on the charts. Don't fire unless you have a clear, perfectly defined target. The fix here requires a major mindset shift. You have to actively accept that doing nothing is a completely valid, highly profitable trading decision. Honestly, it's one of the hardest disciplines to master. Wait for the market to come to your levels. Protect your ammunition so that when the perfect setup finally appears, you actually have the capital to pull the trigger.
Mastering your trading discipline. Let's pull all of this together.
At the end of the day, ignoring stop losses, oversizing, and overtrading, they are all just failures of emotional control. I absolutely love this quote from the source material. A patient trader with a second-rate system will generally outperform an impatient trader with a better system. That hits the nail on the head, doesn't it? Professional trading is about leaving your ego and emotion at the door and sticking rigidly to your risk management rules.
I'll leave you with this provocative thought to conclude our explainer today. Do you have the discipline to do absolutely nothing when the market demands it? Treating your trading like a highly disciplined, risk-managed business and not just a casino, well, it starts with your very next click. Thank you so much for joining me on this explainer, and hey, come back and review these lessons anytime you feel that urge to break your own rules. Stay disciplined out there.